Today's discussion is about difference between crowdfunded loan and loan from bank. Firstly, we will discuss what a loan from bank is. Every one of us knows what a bank is, and we are certainly sure everyone is also aware of bank loans. Still, for the sake of people who do not know, bank loan is most common form of capital help provided to a business from a bank. This loan is normally mid-term or long-term loan set for 3, 5, 10 or more years, wherein you have to repay it along with interest. The bank approves this loan after it gets some security from the business. Here, security stands for some guarantee which the business will give to the bank, which can be in terms of pledging property against loan taken or pledging shares, stocks or some other guarantee. For a startup though, if the bank agrees, security can be in the form of personal guarantee from the entrepreneur himself. Types of loans. Open-ended loans. Loans which you can borrow over and over again are open-ended loans. Credit cards are a good example of such type of loans. Closed-ended loans. Loans which are provided only one time and cannot be renewed are closed-ended loans. If the company wants to apply for a loan again, then it has to go through the entire application process. Secured loans. Loans which are taken after giving a guarantee to the bank are secured loans. If the company defaults, then the lender will recover this money by taking possession of the guarantee. For this reason, secured loans have less interest rates. Unsecured loans. The company does not give any guarantee or asset, making such loans difficult to get. These loans have high interest rates. The bank usually takes into account your credit history and your income before it gives loans. In case of default, a lawsuit may be filed to recover money. Crowdfunded loans are loans which are raised online by a startup. Owner or a team from the startup will reach out to people and convince them of the new idea. If people feel the idea is genuine and has a good monetary aspect, then they will grant funds to that startup. The investors can donate from small funds to even large donations to these startups. It is to be noted that fundraising and raising money from the stock market is different than crowdfunding. In fundraising, the money is raised for a charity or a cause. In money raised from stock market, companies do not target individuals directly. They put stocks or shares of their companies in the market and anyone can buy, including individuals, institutions and also other companies. Types of crowdfunded loans. Reward-based loans. The startup will pre-sell product or service and launch their business, but it won't give equity or shares and will not incur debt. Equity loans. People funding the startup will receive shares, usually at the initial stage. Other types of crowdfunded loans include software value token loan, debt-based loan, litigation-based loan, and donation-based loan. Let's have a look in the difference between crowdfunded loan and loan from the bank. Finance provider. For a bank loan, application has to be done in a bank. A platform or website is used to campaign in crowdfunded loan. Ease of getting loan. Bank loans can be easily taken. If you have a guarantee, then a bank should give you loan. Bank will prefer settled business with good cash flows and profits rather than a startup. It is difficult to get crowdfunded loan. One must find investors, pitch an idea, have a good product or service backed up with convincing ability to get loan. Repayment. The business has to commit to meet loan repayments and interest, irrespective of company making profit or not. Failure to pay this money can result in bank charging penalties or putting the business into insolvency. All crowdfund investors know that for a startup to run, it takes time along with patience. Repayment is usually done on an already agreed basis between the parties involved. Idea validation. Bank loan will require a strict verification of the credit scores and account histories of the business and of the person or people who apply for loan. Bank will not decide about the practicality of your idea. Crowdfunded loan actually helps in validation of business idea since startup has to get investors to rally behind their new project. This will give startup an idea of the market potential before even starting with the business. Ownership. Once bank loan is repaid, the person or group of people are the whole and sole owners of the business. Mostly, the investors will have some shares or ownership in the startup having crowdfunded loan. Preferences. Bank will preferably offer loans to traditional businesses like accountancy firms, manufacturing and production units, etc. The industry in which business operates must be established. A business serving limited number of people in a town or city is preferred by banks. Crowdfunding investors prefer new, flashy ideas which will help define and solve some problem faced by humans or businesses in general. The business must operate in niche industry or some specialized sector. They will prefer startup which is serving a big portion of the human population, preferably throughout the world. Viewpoint. Banks are less concerned if the business they are funding changes people's life and are more inclined to recover their invested money. Changing people's life is the main viewpoint of crowdfunding investors. Time. Banks take months to process loan applications, keeping the business waiting. Crowdfunded loan can be processed in few days to few months' time. It depends upon how quickly the business is able to convince investors and complete the formalities specified by the crowdfunding website or platform. What more differences can be added to our today's topic? Are you also business owner looking for loan to run your business? Which loan would you prefer for business? Let us know in the comment section below and like and share this video.